Canada has no inheritance tax, no federal estate tax, nothing like what Americans face. And yet, some Canadian families still lose 30, 40, even 50% of an estate to the government. How? Because while Canada doesn't tax the person receiving the money, it can heavily tax the person who died. And if you don't plan for it, that tax generally comes out of the estate before your family sees a dollar. In the next 5 minutes, I'll show you what generally happens to your money when you die in Canada, and the simple moves that can save your family a fortune. Quick but important note: this is general information, not legal, tax, or financial advice. Rules vary by province, they change over time. This is mid-2026, and Quebec plays by its own rulebook. Before you act on anything here, talk to a lawyer and a qualified financial advisor. All right, let's get into it. Here's the rule almost nobody knows. When you die, the Canada Revenue Agency generally treats most capital property you own as sold at fair market value at death. Your cottage, your investments, your rental property. Many assets all at once. It's called a deemed disposition. There's no actual sale, no money changes hands, but the capital gains you've built up on those assets generally become taxable on your final tax return. Let's make that real with an illustration. Say you bought a cottage in the 90s for $200,000 and it's worth $800,000 when you die. That's a $600,000 capital gain. In Canada, under current rules, half of that gain, $300,000, gets added to your income in your year of death. Stacked on top of everything else, much of it can land in the highest tax bracket. Your estate could owe well over $100,000 in tax on a cottage nobody sold. And here's the part that catches families off guard. That bill generally comes due before your kids inherit anything. If there's no cash in the estate to pay it, they may be forced to sell the very cottage you wanted to keep in the family. Now, capital gains at least get that 50% break. Your RRSP doesn't, unless a qualifying rollover applies. When you die, the entire value of your RRSP or RRIF is generally added to your final return as regular income. Every dollar, a $500,000 RRSP can push your final return deep into the top tax bracket. And in most provinces, that means the government takes somewhere in the neighborhood of half of it. One more trap. The financial institution typically pays the named beneficiary the full amount, while the tax bill generally lands on the estate. So one child, named as beneficiary, can be handed the entire account while the tax comes out of the estate everyone else shares. And in some cases, the CRA can even come after the beneficiary for that tax. Families have gone to court over exactly this. Now for the good news, and it's very good. If you leave assets to your spouse or common law partner and the transfer qualifies, almost all of this tax gets deferred. It's called the spousal rollover. Your investments, your property, they can transfer at your original cost, so no capital gains are triggered at that point. Your RRSP can roll directly into your spouse's registered account, tax-free for now. The tax doesn't disappear. It's deferred until your spouse sells the assets or passes away, but that deferral can be worth hundreds of thousands of dollars. It's usually the single biggest estate planning lever for married and common law couples in Canada. And your will and beneficiary designations have to be set up properly to use it. Here's the stat that should scare you. According to national surveys, roughly 58% of Canadians don't have a will, die without one, and your province decides who gets everything using a rigid legal formula. Not you, not your family, a formula. In Ontario, for example, your spouse currently gets the first $350,000 and then splits the rest with your children, even if you wanted your spouse to get everything. And in some provinces, a common law partner may have no automatic inheritance rights at all when there's no will, no matter how long you were together. Have young kids? Without a will, a court appoints their legal guardian, and it may not be the person you would have chosen. So, at a bare minimum, your will should cover who inherits what, who your executor is, guardians for your children, and backup beneficiaries. And your registered accounts and insurance need named beneficiaries that actually match your plan. Let's finish with 3 planning moves worth asking a professional about. 1. Use beneficiary designations. Naming beneficiaries directly on your RRSP, your TFSA, and life insurance generally lets that money pass outside your will and skip probate. That's the court process that validates your will. Probate fees can be significant, and they vary a lot by province. In fact, my next video ranks every province's probate fees from free to brutal. 2. Know your exemptions. Your principal residence can often pass on tax-free under the principal residence exemption, but your executor still has to designate it properly on the final return. And life insurance proceeds are generally tax-free to the named beneficiary, which is exactly how many families cover that final tax bill without selling the cottage. 3. Plan while you're alive. Strategies like gradually drawing down your RRSP in lower income years, spousal rollovers, or an estate freeze for business owners can dramatically shrink the final bill. These are advisor conversations, but you have to know to ask. Death and taxes may both be certain in Canada, but how much tax your family pays is not. Remember, this was general information. Your province, your situation, and your beneficiary designations can change everything, so sit down with a professional. Because a will, correct designations, and one honest conversation can be the difference between your family keeping what you built or writing a very large check to the CRA. If this was useful, subscribe. Next video, the probate fees every province charges, ranked from free to brutal.